Good evening. Hong Kong's stock market plunged to its lowest level in 9 months after the U.S. Federal Reserve signaled an end to the free flow of money from its stimulus program. Adding to investors' fears, China's central bank tightened credit further and manufacturing activity on the mainland recorded a surprise drop. ATV's Belinda Lloyd reports.
It was carnage across Asian markets today, with Hong Kong one of the big losers. The trigger was the Federal Reserve indicating it could start scaling back its $85 billion monthly spending on bonds later this year, with a view to ending the stimulus measure altogether by next year. The bond buying program was in place to keep interest rates low to boost borrowing and spending. That sent Hong Kong stocks on a tailspin as investors were spooked by the prospect of an end to free money flooding the markets. The Hang Seng Index plunged 2.88% or 604 points to close at 20,382, its lowest close since the 13th of September. Turnover stood at $75 billion. High dividend sectors such as property and real estate investment trusts were hit hard. Adding to the turmoil in Hong Kong were surprisingly weak figures on manufacturing activity on the mainland. HSBC's preliminary purchasing managers index fell to a 9-month low of 48.3 in June, down from 49.6 in May. Numbers below 50 indicate a contraction, and analysts see this as a sign that a second quarter slowdown could be sharper than expected, given that it's the second month that the PMI fell below 50. The weak PMI combined with a surge in interbank lending rates to bring down stock prices as the People's Bank of China tightened credit. Stocks in Shanghai took a hit, closing down 2.7% at 2,084 as lending rates reached historic highs on the mainland. Other bourses in Asia were not spared.